Welcome back to the channel, everyone. Today I want to talk about how the market crash is coming sooner than you might think. Today I want to talk about what causes and amplifies a market crash, and also talk about how the current market crash is already upon us. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, this tweet is an extract directly from the Federal Reserve report on the 1987 market crash. This report talks about a number of factors that contributed to the severity of the market crash, aka what caused the crash, and also what amplified the impacts. The report is broken down into a few key sections. Number 1, margin calls. Number 2, program trading, which is the equivalent of credit default swaps and put options. Number 3, the Fed's response. And number 4, the trading and lending of securities. So it says market calls, as they were implemented during this period, was one factor that reduced available market liquidity, especially in the futures markets, and likely contributed to the severity of the decline. Now obviously margin calls is something I've spoken about on the channel quite heavily over the last year. We know of a number of large short hedge funds that are very over leveraged on risky long tech positions that have lost substantial available liquidity and are likely to be margin called in the coming days, weeks and months. These hedge funds like Melvin Capital have been long on stocks like Snapchat, Affirm, Facebook, Snow and many others, which are down significantly from their all-time highs, some over 70, 80 or 90% from their all-time highs. Now obviously when these hedge funds end up being margin called, they will be forced to sell off their long positions, crashing the wider market, but also, interestingly enough, forced to cover their short positions, such as their AMC and GameStop shorts. Right now, there could be a number of large hedge funds or short hedge funds that are currently in need of additional margin to meet their margin requirements, and therefore have been pumping the cryptocurrency markets over the last week or so. Over the last few weeks, Bitcoin has risen from its recent lows of around $34,000 per coin to well over $47,000 per coin this morning. Now we know that Ken Griffin and Citadel have recently entered the cryptocurrency markets, as have a number of other large hedge funds and short hedge funds as well. This pumping in the crypto market could be to create additional liquidity to meet their margin requirements to avoid a margin call today. Now number 2 is program trading. It says there has been some debate about the extent to which program trading, especially portfolio insurance, aka credit default swap insurance, contributed to the crash. It says portfolio insurance was designed to protect individual investors from losses. Now obviously credit default swaps pay out when the underlying bond or security ends up going bankrupt or declines substantially. And it says, but when used by many investors simultaneously, it may have helped make the fall in prices a systemic event with a feedback loop. Obviously, as the prices of stocks start to crash, these insurers would have had to pay out massive sums on the credit default swaps and the portfolio insurance. Obviously, to do that, these insurers would have had to sell off a number of their assets, aka their stock positions, which would have obviously caused stocks to crash more, causing them to pay out more on their portfolio insurance. You may say, Tom, surely portfolio insurers don't actually hold any stocks, do they? Well, the report says that roughly 40% of the non-market maker sales in the futures market was conducted by portfolio insurers. And therefore, interestingly enough, not only do these insurers hold a massive amount of stocks, bonds and futures, but they also actively trade them as well. It says the downward pressure exerted on futures markets from sales by portfolio insurers may have contributed to the discount that formed in the futures market relative to the cash market. Now you may say again, okay Tom, credit default swaps and portfolio insurance were a big deal back in 1987 and 2008, but surely those institutions don't sell portfolio insurance or credit default swaps anymore due to all the risk. Well, interestingly enough, as of the 29th of January 2022, it says record CDS and ETF volumes suggest nervousness in credit. Trading volumes across major credit default swap indices and debt exchange traded funds have broken records in January 2022, a sign of a significant reshuffling of investor exposure to corporate credit. About $800 billion in volume has changed hands across the 4 main US and European CDS indices this year in January 2022 alone, a third higher than the previous January record set in 2020. even higher than the March 2020 pandemic highs as well, and believe it or not, even higher than the 2008 highs as well. And therefore, not only was portfolio insurance a big deal back in 1987, helping to amplify the crash, but it's also a big deal right now in 2022 and will help amplify this crash. Guys, many of you may not have a lot of confidence in the stock market at the moment. There's all this market manipulation and market fraud that seems to be going entirely unpunished. And that's why I personally also invest in cryptocurrency, especially now that Bitcoin is starting to break out. I personally like to use BlockFi as my investing platform. If you sign up to BlockFi using the link in the description below, you can currently get up to $250 in free Bitcoin. More than 500,000 people and 350 institutions globally use BlockFi to manage over $10 billion in assets. The BlockFi platform is also entirely free and requires no minimum balance. BlockFi also offers a rewards credit card with an introductory rate of 3.5% cashback on your purchases, also paid in crypto, so you can continue to accumulate more and more. There's also no annual fee and no foreign transaction fee, and the card is currently available in the US. So guys, be sure to sign up to BlockFi using the link in the description below to get up to $250 in free Bitcoin. Now, number 3 on the list is the response from the Federal Reserve, which is interestingly enough different this time round to 1987 in all the wrong ways. The report says in an effort to restrain the declines in financial markets and to prevent any spillovers into the real economy, the Federal Reserve acted to provide liquidity to the financial system. So then the Fed issued a statement suggesting that they would be supporting market liquidity, and that statement was referred to by one market participant as the most calming thing that was said. The Fed followed up by cutting federal funds rates down to around 7% from over 7.5%, and also cut other short-term interest rates as well. But obviously right now, in 2022, the Fed isn't talking about cutting interest rates, it's talking about rising them 6 or 7 times over the next few years. Now obviously if cutting interest rates was the most calming thing that was said, I can't imagine rising interest rates can be all too good for the market. And in terms of securities lending, John S. Reed, the chairman of Citicorp, had been quoted as saying that his bank's lending to securities firms soared to $1.4 billion on October 20th from a more normal level of $200 million to $400 million. Now again, we know that securities lending and short selling is at an all-time high right now in 2022 compared to any previous year. And it says government and in particular US Treasury securities are often used as collateral in repurchase agreements and other financial contracts and can also be pledged to satisfy margin calls. Trading and lending of these securities is an important source of market liquidity. After the stock market crash, there was reportedly some reluctance by holders of government securities to lend them as freely as they typically did. Now, interestingly enough, the spread or the yield curve between the 5-year and the 30-year US Treasuries has inverted for the first time since 2006. So a normal yield curve is supposed to look like this, with the further maturity dates generating a larger yield. Investopedia says the above chart shows a normal yield curve, exhibiting an upward slope. This means the 30-year Treasury securities are offering the highest returns, while 1-month maturity Treasury securities are offering the lowest returns. This scenario is considered normal because investors are compensated for holding longer-term securities, which possess greater investment risk. Now obviously an inverted yield term is where the shortest maturities pay the highest yield and carry the largest risk. It says a yield curve inverts when long-term interest rates drop below the short-term interest rates because investors expect short-term rates to decline in the future, typically as a result of impaired economic performance. Such an inversion has served as a relatively reliable recession indicator in the modern era, and that's exactly what's just happened over the weekend. We can now see that the 5-year Treasuries are paying a greater yield rate than both the 10-year and also the 30-year Treasuries as well. This is the gap between 5 and 30-year yields on US government bonds fell into negative territory on Monday for the first time since early 2006 as a sell-off in the market resumed. While parts of the yield curve, namely 5 to 10 and 3 to 10 years, had already inverted last week, the slide of the gap between 5 and 30-year maturities of the biggest bond market in the world into negative territory raised concerns the US central bank's hawkish approach to stamping inflation might hurt growth. And therefore, bonds are currently indicating that a massive market recession is coming very, very shortly. And this coming recession is going to be amplified by margin calls, program lending or securities insurance, and also the Fed response and securities lending. And also the geopolitical climate of what's happening between Ukraine and Russia is only going to amplify the current market crash even further. David Malpass said what's currently going on in Ukraine comes at a bad time for the world because inflation was already rising. We know that inflation is already at a 40-year high, and this is only going to be amplified over the next few months. This is already causing an increase in food prices and also energy prices, and this is only going to add to the increasing inflation and also compound the current economic crisis. Guys, be sure to let me know down in the comments below what you think about a market crash coming sooner than you even thought. And as always guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.